Hello, everyone. I'm Steve Ankerstar, and thank you so much for listening in to our second quarter of 2023 Investment Advisory Board meeting on behalf of everybody here at the team Ankerstar, as well as the members of the advisory board. Thanks for listening in tonight. There is a chat room to be able to put your questions in. So if you think of those, I'm not monitoring during the presentation, but put your question there and I will get to it once we get to the questions portion. I am using a slightly new format where I'm going to focus on getting through the material much more quickly, as well as more straightforward, and then allow time for questions. If there are not questions after that, then we will end faster than we have in the past. With that, I want you to go ahead and take a look at the standard disclosure. These are all my projections that I've put into this briefing personally. We haven't quite stood up our charter with the board yet, so all the signatures or all the board members will eventually sign off on this presentation before it's presented. But right now, it's just my own projections with the information that I provide you in this briefing. So take that, do your own due diligence there. If you have any other questions, I can give you this full disclosure. I can send it to you, or you can pause if you're watching this on a replay. Quick advertisement. Here's who we are, and here's what we do for you. You can see the members, the 5 members of the team there on the slide, as well as Candace, who's the glue that holds everything together. So you may be working with any one of us at any point in time, but of the 4 advisors, one of them is assigned as your primary advisor. We are going through a little bit of a transition process. If you're affected by that, you will find out in the next week or so. At the bottom, rapid response to clients' concern, what makes us different, what you can tell other people if you're referring them to us, as we take your phone calls and we answer them in quick manner. So that rapid response to client concerns is what we pride ourselves on, and what we do better, honestly, than everybody else. And over on the right, what do we do for you? We're going to make you as much money as we can within your risk tolerance, which is that risk number we talk about and we put in your contract. We're going to coach and mentor you through volatile times and to avoid mistakes. And if you're going to make a mistake, or what we call a mistake in our book, we're going to mitigate the damage of that. So that's what your team is dedicated to doing for you as a client. All right, off into how was the first quarter of 2023? Well, it was better than all of 2022. 2022 was largely a year that was marked by interest rates going up and inflation going up, and then the market going down. Not just the stock market, but the bond market, crypto, precious metals, emerging markets. It did not matter. There was really no safe place to hide outside of private equity, which again is there to take advantage of distressed assets. So last year, super painful. 2023 doesn't feel like it's any better, but I want you to take a look at the numbers. The top numbers are from Ankerstar Wealth. These are only the Schwab numbers. So this is a subset. I did not cherry pick it. This is just a subset of the entire book. It's about 60% of it that can shows where we started the quarter on this slide, 31.7 mil. We ended at 35.9. There's several ways to win during the quarter. You can bring on new money. That's the net new contributions, brought in 1.1 and change. We also had a lot of outflows this quarter, last quarter, due to the taxes that people are having to pay. So overall, very proud of that income. The next one down is from sheer bond interest. So 220K with Schwab across the book there. Capital appreciation, that's what you care about. That's making money through things, gaining in value, 2.8 million. And then a couple of minor things there at the bottom. But really what I want you to take away from the slide is, if you look at the capital appreciation and the income, that's your existing clients' portfolios making money, not new money you put in, just the money you've made. It's about 3 million. Take that into 31 million. It's about 8.8% is what we averaged across the book. Obviously, how you're invested, the more aggressive you are, the more money you made. The more less aggressive, the less money you made this quarter, but pretty much across the book, everyone is up. If you look down at the bottom there, these are the numbers that are the published numbers for the quarter itself. If you look at the U.S. market, overall was up 7.4%. So proud that we beat the overall market. Value and growth, it was all growth this quarter. So remember, if you're at the end of the year in 2022 saying, I don't like the pain, I want to switch out of the tech names and I want to switch into value names, well, this is what happens when you give up on growth. When growth comes back, it comes back quickly. So if you sat out this entire quarter, you watched well, you didn't see it because you don't know what you missed out on. But growth going up 14.8%, while your standard toothpaste and cheese stocks hardly moved in the green at all. And again, thinking the Dow was hardly up, but the NASDAQ was up, up into the teen percentages. So just wanted to throw that out for you there. That's why we tell you to stick to the strategy. If you're involved, if you go into tech with us, then we're in best of breed tech. We're going to hold on to that best of breed tech and we're going to add to it. On the bond side, there was not much difference in high yield bonds, which is normally where you take all the risk and make that, market beating return or, treasury beating return, if you will. But with the Fed increasing interest rates, you could get the same amount in CDs and treasuries. Right? Treasuries are still paying on the 4%. So we'll talk about that a little bit more, but across the board, there's how that's what you can get for on the fixed income side. So where 2022 was, everything was in red, 2023, everything is in the green. Will it stay there? I'll give you my forecast here in a slide or so. Okay, here's the overall book overview. Here's the actual number of everything that we managed put together. And you can see the combined everything, 57.3 million. We started the year at about 51 million. So we grew at about 4.4% and change, and then 2 point something and change. And this last month was 2.8% and change. So all in all, that adds up to about that 8.5%, 9% area for the book. As far as specifics, a lot on this slide. Look at the middle column under the standard investments. The only real change on here is there was the bold numbers are the current numbers. So some money flowed out of the ETFs, the second line down there, from 27 to 25, basically percent. Where did that money go? It went into bonds. CDs are counted as bonds as far as the slide. So it really went into CDs. So what have we been pushing in the beginning of 2023 is let's lock in that 5% plus on a 3, 6, 9, 12 month, 18 month CD. If you want to go out to 2 years, you're probably going to be below 5%. But if you want to lock up a long-term bond now at 4% for like a decade, and that's right for some people, don't put your money into annuity. You can just get that in a run-of-the-mill old boring CD. Right now, getting a 4% CD would be dumb because you can get almost 5%. However, these 5% rates, when those mature, they aren't going to be there. In my opinion, the market is pricing in that as soon as we stop raising rates, we'll pause for a while and then rates will come right back down. And that's when you look like a genius because you had that, longer duration with, if you will, a longer maturity point. So over in the right-hand column, alternative investments. If you're a accredited investor, meaning, you meet the criteria, a couple $100,000 in income and, or you have $1 million of investable assets, I can accredit you, sign a letter, makes you accredited, and we can invest in private equity. Private equity thrives in a distressed environment. Okay. So if this recession, and we don't know whether the recession is coming or not, but if it is, you're going to want to have some exposure in private equity because they're the ones out there that have the suitcases full of money that can come around and buy distressed assets if things get bad. They did that through 2007 through 2009. That's why we have exposure there, is because if that happens, and we don't know that it won't, right? If that happens, then they're going to be the ones that are going to take advantage of that. I have a story called The Story of Two Nevers that I'll tell you here in a minute. We have some other things. If you're interested in this stuff, as what I would say normal investors, is the stuff in the right-hand column isn't right for most people unless you want exposure outside of the stock market. And then we have that available for you. Okay. Next slide, top 10 holdings. I'll go through these briefly. Number one is Apple. Apple was up, I think, 20% in the first quarter, regained its status as the best tech firm out there. It really is that good. If you watch CNBC, you'll hear people saying now flight to quality and extending duration. The flight to quality started 15 months ago. It started at the beginning of 2022, right? So anybody who's saying flight to quality should be stay in quality, right? You only stay in the best names, and even the best names look stupid sometimes. I look, with Apple, Alphabet, and Amazon all got hammered there for a while, but they're screaming back. They're still the best places to have. And they have the balance sheets to where they don't care if Silicon Bank or Signature Bank or really any other bank goes under, because they have that cash on their balance sheet that makes them the place to have your dollars, even though they are high risk because they're tech. They're safe because they're huge. Okay. And they have a lot of levers to pull if they need to. And you've seen Amazon doing some layoffs, Alphabet doing some layoffs, Apple's not, but they've stopped hiring, which is kind of the same because they grow so fast, right? So the three of the top four there are your best of breed tech firms. That is not changing. I do not forecast that to change. If anything, we're picking up shares on the cheap. First Trust Tactical High Yield Fund. This is an amazing fund. It yields over 10% in a world where cash is king, right? When things are falling and you want things that kick off cash, right? Whether you live off it or you have it to reinvest, which means you're reinvesting it while the market's down, which means you're buying low, which is the goal, not to sell low, it's to buy low. So things that kick off cash have really increased in allocation in our across our models, which means they've shown up in your accounts. So I love this First Trust Tactical High Yield Fund. It's second only to Apple. Buffer has dropped 3. The parentheses at the end are the moves up or down, similar to like a top 25 ranking. Buffer, we don't need quite as much. We're not out of the woods. This is not the all clear signal by any means, but we need less buffer in our portfolios as we start to now go back long, depending on your risk tolerance. My more aggressive folks are almost all back long, completely long, but there's a little bit of this hanging out. And if you have a larger portfolio, you're still going to have some of this, right? And that's where I go. If you need cash, that's where I'm going to go grab it from. BCRED is Blackstone Private Equity, JEPI and Vanguard and the Vanguard Total Bond Market Fund, those 3 that are new there. JEPI is a world-class premium income fund. They use advanced use of options to kick off income. It's one of the largest ETFs, if not the largest ETF out there. But it's huge and they're very good at what they do, and it works in a volatile market. When the volatility goes away, which seems like it could be months, years, we'll reduce our exposure to that once the volatility reduces. But as long as volatility is high, we'll go long and strong in JEPI. There's its little brother out there called JEPQ, which focuses on smaller firms. It does the same thing. And the last thing, cybersecurity, even though it got beat up with the rest of tech, cybersecurity is still the main theme going forward that we are invested in, that is going to always be on the rise. All right, 2022, all you saw was red on this slide. The green has returned at least for a quarter. We shall see. But the takeaways from this very busy slide are the things in red. What has not worked? Investment grades still are not. They dropped in that mark to market. If you followed any of my videos on why the banks went down, it's all, or if you have bonds or CDs, you've been calling me and saying, why are they at less than par? That's mark to market, right? And that's the law that came out of 2007 through 2009, and it causes pain. But that's the reason. So investment grade bonds are down and preferred securities are down. Largely those are down because you can get the same thing right now with less risk by going into CDs or treasuries. So I can't remember the last individual bond I bought because I would just buy a CD instead, right, and get the same return, which with less risk. We use risk numbers here. So bonds are around that 25 risk score. A CD is down at 10, and it's only at 10 because of the banks recently, right? It's normally around that 2 or 3 risks. So it's almost same as cash. And then the financials on the right, the big banks, again, they got taken down, if you will, in the first quarter, some of them to the tune of 20-25% for big, strong, solid banks. They just, that's the bathwater, or that's the baby going out with the bathwater, right? The regionals, in my personal opinion, is it's oversold. Yes, there was, the Silicon Valley Bank mismanagement. There was the Signature Bank, which I don't know that one as in depth of why it ran into issues. Credit Suisse had issues. They're all being backstopped by the government. They're also being bought by other companies like UBS buying Credit Suisse. I do not think there is a systemic financial issue at hand. I think there's mismanagement issues at hand. And what do you do when that happens? You fire management. You put like actual managers in place. Part of the things, there's been an increasing in the management / C-suite levels focus on diversity efforts and new and other things other than the core business models out there. And that's great. And that's very supportive of different causes. However, at the end of the day, that can get you into trouble financially if you support those things and you don't pay, laser focus on your core mission. The phrase you'll hear out there is go woke, go broke. That's not necessarily true, but you got to focus more on your primary mission than other things out there that you support. So I think the big banks are a buy. I think the regionals are a buy here. You can see off to the right-hand column, pretty much everything is the same. The things we added in things we added in quarter 4 of last year were ServiceNow, Blackstone, and BXSL, which is the Blackstone Secure Lending. Some people had that, but we put it in the model, so now almost everybody has it. In quarter 1, picked up Schwab, that's SCHW. Across the board, there are some accounts that cannot hold Schwab, depending on what else you have in your account, which is interesting because they're custodied at Schwab is the reason. And then KRE is the regionals. Bought into that pretty heavy already. I was too soon. It went down further. However, I think you're going to be very happy once this thing turns around and actually the entire banking system across the United States is not going away, which I hear people pitch that to me every day. The dollar is dead and the banking system's going under and the country will soon after. We're 2 years out from another major election, so just vet what you hear with common sense, right? Because you're going to hear only extreme stuff on the media for the most part. What are we adding next? The housing market is very interesting because it did get hit, but it got hit kind of late, and it's already started to recover a little bit. And the mortgage companies got way out in front of this by laying off a ton of people, which makes them really attractive as far as when that housing market picks up, those mortgage companies are going to be hiring and exploding higher. So I'd rather be a little bit too early on it and lose a little bit on the downside before it goes up than miss the move higher. Is the point. So that's why you're going to see some stuff. I won't talk individual tickers because I haven't bought them yet. Okay, here's the forecast. This is generally the whole purpose of this. 16 minutes into it. Sorry, I got long-winded again. If you only take out what's red there, that's the important part. Again, people are all over the map as far as slightly optimistic to slightly pessimistic, and then you have Blackstone saying, you need to protect your money because what if Joe Zeidel, what if rate hikes don't slow inflation? And we've seen that. So let's start top to bottom. Let's review. Biggest thing in quarter 1 was the bank stability was challenged. The Federal Reserve tends to, if you look historically, they raise rates until they break something. Okay. That's what was being argued for the past 4 weeks on, did they actually break something or did just some crappy bank go under? Hard to tell, right? Because the more they looked in the Silicon Valley Bank, the more they found that these people weren't banking veterans and they blew it, right? So the Fed felt confident in raising another quarter point because they didn't really break that one. That one kind of just suffocated under its own incompetence. But that was the theme and it brought everything else under scrutiny, right? And there are plenty of small town America went into their small town regional bank and took their money out and took it to cash. That can cause an alarm, right? The run on banks. That's a big deal. Do that if you feel you have to do that for your family, and then hope your house doesn't burn down if you're sitting there with $300K in cash in your house. But do what you have to do. I consider the banks stable. I consider them safe. They are fully backstopped, each bank up to $250,000 per individual. I am not worried. However, I cannot not ease all the concerns that are out there. Okay, what's coming up for the quarter 2 is really, it's the story of the rate hikes. We could either be done. If the Fed's done, I want them to be done. I really so want them to be done, but that doesn't get anything right? Probably 1 or 2 more, but I think they're done in this quarter. So there's 2 more meetings this quarter. So either 0, 1, or 2. I cannot see anything. I cannot really see this going into the second half of 2023. Otherwise, we are going to be breaking crap left and right. And that is going to get ugly. So we're still prepared for that. We have buffer in there. We have big dividend stocks. We have a lot of things that kick off cash that's protecting us in case that happens. But the primary, is slightly optimistic. It's done this quarter and we're moving on. The 2023 overall forecast, again, volatility through the first half and then increase in the second half. Realize if the NASDAQ flatlined from here, 2023 would go into the books as a 15% up year. So, that's why you don't sit out. Don't get in cash because you missed out on that 15% gain already. But then again, the worst case, you always have to have the worst case in mind, even though you're like, that's not going to happen, is what if inflation sticks around? And I think the Fed's realistic in the fact that they're not going to raise rates to kill inflation. They will at some point stop. So we're not going, I think, over 6%. We're at 5% now with the short-term rate, maybe 6%. If it goes above that, I think we're causing more damage and then we are in trouble. So, and I'll address that if that happens. Okay, the story of 2 nevers. Two things have never happened in history, and one of them is going to get broken with this recession. So first of all, are we going to have a recession? The inverted yield curve. You've heard me talk about it several times. I've done individual shows on the inverted yield curve. That is the case we're at right now, where short-term rates are around, the 2-year, year and a half, 2 years up around 5% because the Fed sets that. So it's like they push the tent post in the short term up. But the long term of the market, where generally you hold stuff longer, you would get paid more. The market is it's all of us. It's forecasting that interest rates drop, and they drop significantly, and they drop soon. Like as soon as we're done raising, we're going to turn around and drop. That's what the market has priced in. That's everybody voting. So you cannot ignore that. In that case, that's the inverted part. The short-term rates are higher than the long-term rates. We have not had we've never had an inverted yield curve this inverted that didn't lead to a recession. Okay, so that is a 100% predictor of we are going to have a recession. And then the other never is we have never had a recession with this level of employment. So what's going to win out? The Fed trying to slow the economy, or the fact that people just want to work and there's jobs out there for them, so therefore the economy clips along? Don't care because everybody's working, and the more people work, the more the economy goes on. So one of those two is going to get broken with this event. We either have the recession or we don't, and it's going to break one of the nevers. But you're going to hear a lot more about that if you haven't already. Okay, how about 2 or 3 years out? I think it's going to be a repeat of 2007 through 2009, meaning there was significant pain. There were distressed assets. People went into bankruptcy. If we have a recession, generally the thinner your balance sheet, the closer you are to being bankrupt, right? So keep cash on hand, be a little bit more conservative with what you're doing. And then let the rest ride, right? So take care of yourself first is the point, so you're not on that. But everybody who doesn't end up hurt by it can now capitalize on lower prices across the board, whether it's real estate, stocks, bonds, crypto, whatever, and come, and catch those low prices. So, and then you've seen from 2007 to 2009, we had like a decade of a straight up, right? So, for the long-term investor, just stick with it, right? It sucks. We hate it. Whatever, deal with it emotionally, however you have to. It's coming back. And when it comes back, it's going to accelerate significantly. All right. The decade summary. The only thing I would caveat with this is these 20% returns that we kind of got used to, the juice, if you will, is probably not going to be there. It's going to be more like the 10% to 12% across the board, which has historically been the case. So if you go back to 1909 or whatever, when they then track them, you're looking at that 10 to 12%. So I think that's more realistic. I think you are going to see a snapback. So we'll have this, the 20, 25, 30% year, but I don't see that continuing like it did coming out of the last recession, if you will. Okay, that is, I believe, all I have. Let's pull up the chat window and give you about 10 seconds here for somebody to put in a question. Otherwise, I will let you go. But thanks again for listening in. As a reminder, I do a morning show almost every morning. We haven't done it this week because we've been doing end of quarter closeout, which is its own particular joy. But we get those out almost every morning. I use your questions to turn around and make shows about. So if you ask me a question and I say, watch tomorrow, that's what I mean. Or if you ask me a question and I send you 3 days ago's video, that's what I mean, is I just answered that question. So keep your questions coming. Let us answer those as a team, and stay tuned because we're trying really hard to get good information out there. All right, one question. Why not bigger positions in Meta or NVIDIA? NVIDIA, I still just trust the management that out of nowhere doubled the share count. So I don't, there's nothing stopping, that's a stroke of a pen from them doing that again and diluting everybody's shares by 50%. They just did that a year and a half ago. So you're like, well, yeah, but the stock has literally gone straight up, right? I don't know, without pulling a chart, 80% in the first quarter, something like that. There's actually some buddies of mine that are all short NVIDIA that are getting cremated by NVIDIA. I don't think the story lasts. I think it's coming back down. So that's my position. All the chip stocks have gained. I mean, Intel's out of there. That's the position on NVIDIA. Position on Meta is I do like Meta and everything they're trying to do, but they've had some big whiffs when they did their huge shift to the metaverse and changed their name. the metaverse didn't take off like they thought they would. I mean, there was that initial, you could go and buy real estate in the metaverse and open your own stores in the metaverse. And, everybody's got an avatar now. You have it through Snapchat, if nothing else. But it didn't really take off like Zuckerberg thought. So then it was the, oh crap. And now that you've seen Twitter go to a subscription model, at least for verified accounts. Facebook has also announced a potential switching to a subscription base. So there's a lot wait and see with Meta. I like it, but it's certainly out there on the high end risk or a high end side of the risk spectrum. What's the current share price of Ankerstar Wealth? If you don't know, Ankerstar Wealth does have private shares out there, and that share price is private. So I will answer that to investors through the investor briefing. All right. Any other questions that we have out there? And I should caveat, there are no shares available for Ankerstar Wealth right now. They are all spoken for. But if you want to go on the wait list, I have 2 people on the wait list. So contact me and I can talk to you more about it in person. All right. With that, thanks everybody for checking in. Yes, it was shorter. So I think I set a new record at 26 minutes. So again, thanks for the feedback. Keep it coming. We try to do things better around here and more efficiently every time. So with that, we'll see you guys in 3 months. Bye.